Welcome to the Salty Investors, episode number 26. And it is Friday, March 31st. It's the end of the quarter, Tim. How are you feeling?
Yep.
End of quarter.
Yeah, good. It was a bit cool last night. What about down your way?
It actually feels like an autumn day here today. It really does. Is that what it feels like up there?
Yep. Yeah,
Up there.
first night of it. So,
how far away are you really? About 150 Ks, probably, something like that?
Yeah.
Yeah.
Not far, but yeah, it's just nice to have a cooler change for once.
Yeah.
It's been hot all year and yeah, nice to get a bit of cooler weather coming through.
Yep, been a long time coming. So let's get straight to the salt for this week. I am going to lead it off because I'm just enraged at the moment. As you may have heard, the government is projecting about 650,000 net migration over the next 2 years. So that's net migration. So I think that's 900,000 coming in and, say 250,000 going out. Something okay. Like that, As Leith Van Onselen at Macro Business points out, in the latest 12-month period, it's been 400,000 net migration, which is more than is being projected per year for the next 2 years. And he says and then most of that came in the second half of the year last year. So, the rationale is that we're trying to keep up with. We're trying to make up for what happened during COVID. He says it's probably more likely going to be 800,000. And as we've stated before here, the majority of the country do not agree with this. And in fact, Labor voted against Liberals trying to raise the cap on net migration only about, 18 months ago. So there we go. Vacancy rates, the rental vacancy rates like 0.5% in all these capital cities. Where are these people going to live? In tents?
I don't know. It's crazy, isn't it?
Yeah.
So, what's that going to do to inflation as well? Surely it's got a few implications elsewhere as well. So,
yeah. Well, I guess it'll stop house prices going down too much. But, I don't know why we want to do that. Making housing more affordable isn't a bad thing, but apparently it is. When a lot of your constituency, if you go through the Labor cabinet and the Labor front bench there, you can see that pretty much all of them are landlords, and Albo's one of the biggest landlords out there. So,
Yeah, and you cross the aisle and the old bald guy over on the other side, he's not, he loves a bit of land himself, doesn't he? So,
yep. Yeah, he's probably loving it. Okay, so what about your salt, Tim? What do you got?
I'm on a similar sort of rant. This Jonathan Siri guy. He's a Greens councillor in West End of Brisbane. Sort of a very nice place to live if you can get there. But he's introduced this thing called a rental strike, and basically it's part of his solution for decreasing rent. So what that is people just refuse to pay rent, and I'm thinking, I would have looked it up. Has this worked in the past?
Yep.
No, hasn't worked. And what's going to be the outcome? Well, surely investors will think twice if they actually go through with it about investing in property. So I can't see how this is a workable solution. And
it's not.
I just think it's a bit hypocritical. This guy needs to take some responsibility for the fires he started in this housing crisis. Like he's increased regulations and he's stopped development in this particular area, and now it's come home to roost, and now he's claiming to be our saviour.
Yeah.
So just think it's a bit rich from some of these people who, put all these regulations and red tape in place to stop people actually building more high density homes in the city, which would, infrastructure is not needed as much, and then complaining about, high rents, and I've got a freaking dumbass idea how to solve it. So
well, yeah. It's the same thing with energy policy. You've got the people who rail against the fact that our LNG producers export most of it offshore and then charge, too higher prices onshore are the same people who wanted to ban LNG, exploration here, more LNG exploration. And, and still say in the same sentence that we don't want to start any new liquefied natural gas, or natural gas projects in Australia at all. You can't make this shit up. And, expecting politicians to understand history, go back and say, what happened during the last rental strike? That's just, none of them consult history, because if they did, they'd have to give up pretty much all their ideas.
Yeah. It just sounds good on paper. I'm actually doing something which, that's probably what started the problem in the first place. You doing something, if you kept your nose out of this stuff,
Yeah.
probably would be the better spot. But oh no,
I just wonder how much environmental regulation just slows down business and just getting all that stuff done, environmental impact statements and all this sort of shit. It must cost an enormous amount of money, and time, to get stuff done.
Yeah, well, he wants green spaces, and
Of course he does.
you're not allowed to build things certain ways, and but then you go to West End, and there's ficking like these 100-year houses, that are full of lead and asbestos, and just dumps. Looks like it's a fire hazard, and they're allowed to just stand there because they're historical, and you can knock one of them down and put 20 families on the one spot, Nice high rise, all new stuff, smoke alarms, all this sort of fancy new technology.
Yeah.
But no. We've got to keep all this places. Oh, just drives me insane. But this guy keeps getting elected, so.
Yep. Yeah, well, it's the same sort of, people in that electorate move in because they like that sort of policy, so he keeps getting elected. I mean, you explained to me how people like Lydia Thorpe keep getting elected. It's just amazing. She's a moron, and people keep electing her because I guess the people in her electorate like her.
Yep. Mm-hmm.
Yeah. Well, let's move on to this week's macro stuff, and there's a fair bit here to get through. So obviously CPI came out year over year. We went from 7.4 to 6.8. That was a lot lower than the consensus, which was at 7.2. We shouldn't pay any attention to consensus because they're always wrong. I mean, we should say that this stuff chops around quite a lot. I don't expect this is going to go straight down. It'll probably sawtooth in the same way that it's doing in the US. But, you would have thought, okay, look, inflation's really coming off. RBA doesn't need to go anymore. They can pause, throw in a banking crisis in the US and, this. But, the thing is, because we put this up last week, you can actually see that, remember, there was like a third of a chance that they were going to cut rates. Now that's come down to pretty much everyone just thinks they're going to stay on hold. So that CPI report didn't move the needle. Or you could say that the futures overreacted to the quote unquote banking crisis in the US. So either way, the market's really they're looking for one rate cut by the end of the year. If you go off, remember this is only 30-day implied futures. So, and they always change, but yeah, so not much change there to it. So the consensus is that the RBA will pause. I got to be honest with you. We had already said at least one more or possibly two. I wouldn't be surprised if they still go again. I wouldn't be surprised if they. I mean,
well,
How
does the market react to that? Does it?
Yeah.
I think it'll shrug it off. I don't think it's gonna. Oh yeah, we sort of thought that was a possibility, but you can see here they don't really.
Well, in the US, they you have banking crisis. The Fed still put up rates 25 basis points. Now maybe there was the expectations that they may have gone 50, but still, that market shrugged it off pretty much, didn't it? I mean, look where it is now. The S&P is back above 4,000. Hey, everything's wonderful again, and and the belief you can hear the cacophony of people going, yeah, the printing machine will go brr as soon as the shit hits the fans, because we've already seen, depositors will get bailed out. I've seen people online talking about this ends in deflation. I'm like, really? Do you think they're going to allow deflation? Have you been paying attention?
Well, even Burry's trucked in the towel now. And saying,
saw that. Yeah, I was wrong to tell people to sell. Oh my God.
So I don't know what that means. Like, holy hell, you're going against. Oh, he's been wrong heaps of times, so I've got nothing really.
Yeah. That's the problem with people who are right, once on a big issue, and then people look to them as gurus. Like, oh, Peter Schiff was right on housing, and what's he been right about since? I don't know, not a lot.
Yeah.
Still trying to live off that one for about 15 years.
Well, he's got a nice house, so obviously he's doing all right. So
yeah. Well, he should. So I just put this up. This came from this is from the Australian Banking Association. as we said, today's the last day of the first fiscal quarter of 2023. As you see there, end of fixed rate mortgage period. So about 78,000 people's fixed rate mortgage ended during this quarter that's ending today. Next quarter is the big one. So you got about 3 times than in the first quarter. And then you've got, this year, I mean, you've got something like over 600,000 fixed rate mortgages resetting to a different rate. Again, most of these mortgages will be fine. They will be. But it just, again, the running theme that we've been going on is that the pain, insofar as it's to be felt by the consumer, by households, is yet to come. That's my point, putting this up here.
And they've got offset. A lot of these people have got extra money in their offset. They've known that this is happening, put away a little bit extra. I don't think it's going to happen, middle of this year. I think it's the tail end is when we're going to get a little bit more. If they keep these interest rates high, if they hold here, and they hold.
Yeah.
So.
Yeah, and the other thing is to say that even if the RBA does hold next week, interest rates are still going to go up because it's lagged. So the effect. So just if they go on hold, okay, that's slightly bullish, but things aren't going to get better for households straight away. So the pain is yet to come, I think. I'll just go back before moving on to that. And I think if you remember back in early January, and I put up that list of about 8 or 9 discretionary retail stocks that had all run.
Oh, yeah.
Pretty much some of them are actually lower than I think I compared them. There was a 2-week period from the 30th of December to the 13th of January. In that 2-week period, I think Adairs had run like 20-something%. It's now lower than it was on December 30th, those retail stocks.
Wow.
Some of them are about flat. Some of them are slightly up. And I think SUL is it's substantially higher, but it's the only one. Everything else is So that the coast is clear. Retail went for a run. Now that's over. So that.
What have they got sales data come through again? Because you said they do it monthly or something, don't they? That sales data that comes through?
But what you've had in the interim is reporting season, obviously, for February. Came out in February. Most of them report mid to end of month, February. All the results came through. I think we discussed a little bit of it back then. All of them were pretty good results. Some of them were saying they didn't see any weakness yet, but they were preparing for weakness, in terms of their inventory and stuff. So they hadn't seen the weakness yet. So then that just goes to the previous point, which is that the pain, to the extent that there is any, is yet to be felt. The maximum pain. Now I put all these. I got excited. I started putting these charts in almost the day after we did the last podcast. So I'm not even sure I remember what these are about. So the point here is that what we've seen in the banking crisis in the United States and Sam Bankman-Fried and all these things, it's all classic end of cycle stuff, I would say. Cast your mind back to the financial crisis. You had Bernie Madoff, banks collapsing, all the crap gets unwound, all those shit coins that were worth nothing get unwound, all of that stuff. And so another thing that happens towards the end of cycles is the ridiculousness of the way people do their accounting. Now, this would have, if the pandemic didn't happen, I would have said that this would have come to a head quite, a few years earlier. Like you saw WeWork, how ridiculous they were with their accounting, their community adjusted EBITDA bullshit. But so this is an M score which measures financial fraud, manipulating financial statements, and of course it's the highest it's been basically since back in the early 80s. And so that says something, because it's higher than it was in the aughts when you had Enron, you had the Big Four accounting scandal. And so it's higher than it was in the financial crisis. So it's just
wow.
it is one of these things you expect to see at the end of cycles. I mean, have a look at where the peaks are there. You can see them peaking close to recessions most of the time, or during a recession even, a lot of those peaks. And yeah, I think it's just an interesting chart to throw in.
I wonder if there's an indicator out there. I know there's people that monitoring earnings calls. If you monitor non-GAAP, how many times that's mentioned in an earnings call, I'm sure that'd be an indicator of.
Yeah, surely. I mean, by now you should be able to just ask ChatGPT, right?
Yeah,
just ask. I mean, they should be able to just comb all that stuff, wouldn't
it? Hopefully, yeah.
Yeah. Oh yeah. So to the point before about all those retail stocks coming back, I probably should have saved that for this bit, but this is so that's the transport index.
Okay.
The first, so you got the S&P up the top. XRT is the transport index. Then you've got, or is that? No, that's retail. Sorry, and then the next one is transports, and those generally are. That's the cyclical, leading. So they all had a nice rally there, but sort of from the mid last year through, early this year, and they've all come off again. So it goes to this thesis, I'll say, is a false start. Question is now whether people are excited about the printing machines getting warmed up, whether we're off to another false start or not. I'm not sure. Yeah. Yeah. So Block.
Darling. It's a darling of the
VC. As you can see, I've got these out of order. This should have been with that other indicator chart about financial fraud. So they had a $540 million gap loss in 2022 and transformed it into a $613 million gap profit by adjusting out share-based compensation, of $1 billion, and just have a look at the adjustments that have gone on. So in 2022, have a look at the size of the adjustments they're doing now, 1.1 billion. Again, it's just how long can you keep doing that? I mean, there are so many analysts out there. It's funny, isn't it, that there are so many people out there that can see through this bullshit, the Jim Chanoses of the world. And yet, a lot of people don't look any further than that sort of top line figure that people give. So again, it's just one of those indications that a company.
Yeah, but there's a lag effect as well, because people believe it because they want to believe it.
Yeah.
And so then you go, how long does that belief go for? Oh well, it can basically go for a long time.
Yeah, and you can fake it till you make it. I mean, Musk did that basically. I mean, he did fake it until he actually made it.
It looks like he's going to get away with it too. And this is the problem. And then all these other smaller companies think they can pull it off as well.
Yeah.
And they don't have, they're not going to make it. Oh, well, Amazon, Amazon. For a long period of time there, like I was just looking at the margins this morning. Wow, no wonder I didn't invest in this crap. Like it looks pretty bad. You go back and you're thinking, when would I have got into this?
I think
never.
The thing about Amazon, you have to remember though, is Amazon raised capital in, I think, about 2001. Never raised capital again. Never needed any. Self-funded everything. So that's the difference between that and
they're still diluting. You just still look at the shares outstanding. I'm still like, wow.
Yeah.
It has to be a super great business to get above all these hurdles. Like you.
Yeah.
I know that. Yeah.
I hear you. I'm just compared to a Tesla though that kept raising capital, floating bonds. The bonds. I mean, I don't know if you remember when the bonds were paying like 8% in a 0% interest rate environment. I mean, they looked like junk. And Musk managed to turn it around.
I know.
Yeah. Warn notices. So I didn't know about this one. The internet is great that you can just access this stuff, because before people used to think, we've talked about jobless claims before. Jobless claims, some people used to say was a leading indicator. It's not really. It's sort of coincident. But these warn notices look like a leading indicator of
Okay.
jobless claims. So what they are is they give 60 to 90 days advance notice in cases of plant closings and mass layoffs. So you can see that ticking up. And of course, you would expect then jobless claims to tick up 3 to 6, 2 to 3 months after. So that was an interesting one. That would be something to keep an eye on.
It was jumped away there, hasn't it? Like
no. Yeah.
Wow, that's really huge, isn't it? So
yeah, you sent me that latest interview with Laxman Achetan on CNN, from the ECRI, Economic Cycle Research Institute. He's pretty good. He's got a pretty good track record, and he says looking like a hard landing at the moment. Definite recession. Goldman Sachs came out earlier this week. I haven't included this and said recession. Definitely. There's a few around.
Consensus is basically 100% now for some sort of recession. So I'm like, I don't know. That's pretty harsh,
Yeah.
So,
well, I mean that to the extent that there's banking stress, and let's say that they've plastered over it and it's fine for now, but if banks have to shore up more capital, they have to raise deposit rates to keep depositors and all this. It's got to have a knock-on effect, doesn't it? I mean, it just has to. You're not extending credit to the extent that you were. It has to. That has a deflationary impact.
Oh yeah.
Yep. So I just picked this up. I thought this was interesting. Mortgage applications are lower than, this is worse than the financial crisis, right? So back to 1995 levels in the US. And again, I think when you look at housing in the US, it's always worse. In this particular period, it's worse than it looks, because you've got to remember a lot of people are financed at 30-year fixed rate mortgages, and they don't give a shit. As long as they don't want to move, as long as they don't have to move, why would you? I've locked in 2%, 2.5% for 30 years, and I got to refinance at 6%. Why would I? But of course, obviously that means that people who could have, there's a cohort of people who probably could have afforded a house, could have got a loan, who now can't, because interest rates have made housing that much more expensive. And the only way this gets corrected is if, prices come down or interest rates come down. So that's the only way it's going to get worked out. So you'd expect building activity to be down.
Well, lending standards have tightened as well. There's seen a few of those things as well, and they're going nuts as well. So when you add that in, so. Yeah.
Sorry, getting a bit carried away there. And I just so this was, I got this from a guy he looks at all this stuff on Twitter, and he just said, look at the monthly house payment in Austin. If you were based on prevailing home values and mortgage rates, is basically almost doubled from a year ago. It's just huge. So if you're in Austin, you got a fixed rate mortgage for 30 years at 2%, beautiful. You are laughing. But if you're in Austin and you're looking to buy a home, and this is what you're facing, you're facing sort of double the monthly housing repayments. It's just crazy.
That's a lot of money to come up with in a month.
Yep.
Nearly $1,000 a month.
Yeah, I mean, you think about it, you could probably come up with $1,800 a month, without too much trouble. But $3,500, shit. On top of, that's a struggle for a lot of people, especially if you're young, starting out, and you think, there's a lot of people that have had to probably can their aspirations for a little while. So let's get to the stock of the week. What have you got for us this week, Tim? Good old-fashioned freight.
Really out of the field for me. You're thinking, wow, Tim's really gone off the deep end here, something that's high capital intensive type.
I thought you went off the deep end a long time ago, mate.
So, but, capital intensive, if you own it now, makes it really hard, and you don't have to really buy more of it. You're not continuing to have to put capital into it. You're just happy with what you got. Makes it really hard for competitors to get in there and, high interest rates. You're not going to go to the bank and go, what I'm going to do is set up a whole high capital intensive business. The bank's going to, pretty much give you a hard time. And I'm also looking for these high beta type stocks that in a recession will get a bit of pain, and this one will, because it's a premium type business.
Yep.
They focus on less than truckload. So you've got heaps of courier business is out there, and you've got heaps of full truckload business, because that's quite easy.
Yep.
But that in between, a couple of pallet type business is really hard to do.
Yeah.
And when we got just in time type businesses, you really need to have that sort of logistics arm to make that work.
Yep.
Yeah, and so you got this problem of, I can. So what I think is going to happen in a recession, people are going to go to cheaper options. So Old Dominion will sort of lose a bit of market share here, and people go to cheaper. But then they realise, their just-in-time strategy won't work.
Yeah.
And the money they're saving on going to a cheaper freight line won't pan out, and they'll have to go back to Old Dominion. And as the economy recovers, people will be happy to spend a little bit more on freight as well. So it's got this double whammy that I'm sort of looking for here. And people the drivers seem, there's a driver's shortage at the moment. No one can get drivers, but everyone seems to love working here because they get paid a bit more. So it's got this, this thing where the good people go to work there, and you've got all the bad drivers working everywhere else. So they've got, a great team, that seems to stick together. They're happy to keep working there, which just makes things run a bit smoother.
Yep.
So yeah, I think you're paying a little bit more, but they're really capital efficient, as you can see from some of these numbers. Yep. You're starting to see, look at these return on invested capital, and gross margins are improving. You can see that, they've gone from the 20s up to the 30s now. Even operating margins.
What's interesting there is that, like, you'd expect in a business like this that the gross margins aren't going to be great, but there's not much difference there between the gross and the operating, right?
Yeah, they're taking it all home. Yeah.
It's a pretty lean operation by the looks of it. Yeah.
Yeah. So you'd be pretty happy not with 29% operating margin on basically any business.
Yeah.
Like even these software light businesses. So and it's got a dividend here of 0.5%, nothing to write home about, but the payout ratio is only 10%. So they've got
as it should be. I mean, if they can reinvest capital at 35% return, why wouldn't you?
Yep, you want them to do it. The interest coverage is like, that's what you want to see, and they're doing buybacks here. You can see they're dipping in. Like, I think it's a little bit high, the earnings, price to earnings ratio to be buying back stock, but it's still nice to be doing. You still got to buy it somewhere. Yeah. When they're at 40 here, the price to earnings ratio, I wouldn't want them to be buying too much more stock, but they did. But like when it's in the 20s, in the low 20s, and and hopefully they've got all this cash on the side here that when things really do implode, they sort of just hold their capital expenditure and take that opportunity to really buy back some chunks of stock here.
Yep.
So I think it's going to be bad for a few years. It's going to be really bad, and then so I just hope you don't buy too early. You wait 6 months, or looking back at an 2008 type situation. Wait till it really does implode a little bit. But they've got the cash to go through here.
Yeah.
You look at this net debt, they're fine.
It's nothing, yeah. I mean, you got 1.6 billion in operating cash flow last year.
And so you look at 10 years, I'm pretty sure we're going to need trucks, even if they're driverless. Or, this is going to be adding to them, So I think they're pretty safe that they're going to be around in 10 years' time. So if you had to pick something out of freight, that's what I'm trying to do. Trying to pick something out of freight that would be, hit really hard. This is my sort of go-to option at the moment. So, yeah.
You heard it here, folks. Tim's done it again. Brought the goods with Old Dominion Freight. So we might leave it there, Tim. What do you reckon?
Yep, sounds good.
That's it. Thanks for tuning in, and we will see you next time.